Well, earnings are in and the data is talking to us. Well, did big tech disrupt the market? And other than artificial intelligence, energy is really the new buzzword around town. So what other sectors can investors find opportunities in? And of course, we can't not talk about the economy and the Fed. We're going to break it all down for you right now on UBS Trending. Hi, everybody, and welcome to another episode of UBS Trending. I'm Anthony Pastore, and it's great to be with you. It's also great to welcome back frequent guest Eddie Gabor, co-founder and CEO of Key Advisors Wealth Management. Eddie, always good to have you on the show. Good to see you, my friend.
Thank you for having me. I really appreciate it.
Absolutely. So, Eddie, let's get right into it. You know, I always love to just kind of throw a bunch of questions at you. But let's start with equities, because April, as any investor will know, was a bit of a rough road for stocks after a very solid rally that we saw since last October of 2023. And sometime in the beginning of April, we hit a recent 60-day low. What do you think the real catalysts are here, Eddie? Because there's a lot of speculation about what's going on the equity side of the market.
So there's a few things. I think the biggest component that has caused this sell-off is inflation and the bond market. It's becoming clear that inflation is this last mile of trying to get it to 2% is probably going to be very challenging and more than likely doesn't happen this year. And when you take a look at the bond market and how it has moved and the strength in the dollar, it has caused this correction. And, I do think it will be a buyable dip. But this is a correction that could get worse before it gets better. And you got to be careful and pretty nimble in an environment like this. And let's not forget, we have had a pretty good run for a few months. So it's about time to have a little bit of a breather. I think these types of corrections are healthy for the strength of the market. But inflation rates and the dollar, absolutely, to me, are the biggest things that have changed that has caused these asset prices to correct.
Right. And it's interesting because, we're still obviously, and we're going to get into the Fed in a little bit, but there's so much data to consistently digest, looking at labor and the GDP and, of course, consumer price index, inflationary data. So it's not surprising that it seems to be a decent amount of volatility right now in the markets.
Yeah, whenever markets have a lot of uncertainty, this is what the result is. And even on the earnings front, right, we're seeing stocks move plus or minus 15 to 20% in some of these high flyers based on these earnings. So even the earnings have been mixed in a sense where you've had some strong earnings and you've had some weak guidance that has spooked the markets. So when you look at the earnings having some mixed signals as well as the bond market, and then you, of course, have the international issues with the Middle East. That uncertainty is something the markets don't like, and that's why you've seen the VIX spike off of the lows and have had this volatility. But again, I'll stress, I think seasonality-wise, it's normally pretty volatile at this time period. And then coming off of a big run-up like we've had, I think one should have expected something like this.
Yeah, you know what they say, sell in May and go away. I wonder if that old adage is actually going to rear its ugly head this time around, or maybe it'll just kind of stay nice and calm for a couple of months. But that seems to be the question, right? Because we are looking at, obviously, the geopolitical conflicts that are happening around the world. So there's a lot of focus now on energy, particularly you're looking at WTI crude. You're looking at, obviously, companies that play in the space. And you say right now there are opportunities. Why do you think that is?
So I think when you look at energy, as we've tried to condition our portfolios for higher for longer on inflation, you want to own things that can do well in a high inflationary environment. And the fact of the matter is we are starting to see the global economies that have been in a recession start to come out of a recession. You look at places like India that's thriving, and Europe is coming out of a recession. China is doing everything they can to come out of a recession. You're going to have a tremendous amount of demand for oil and energy. And we believe that energy is a play that can thrive in an inflationary environment. It can also thrive if you have deceleration of GDP in a more deflationary environment as well, too. So it's kind of a way to take the guessing out of what type of policy we may or may not get. And so energy, to me, seems to be an area that's under-owned. And with the oil prices being where they are, these big companies are going to be generating tremendous cash flow. So we're pretty bullish on energy right now, and we would look to continue to buy dips in this area.
Excellent, Eddie. Thanks. And let's just kind of expand a little bit more, talking about the broader equity side of the market. The last time you were here, and I seem to always ask you about the small and mid-cap markets. I know you're a fan. We are also seeing that there's value here in small and mid-caps here in our chief investment office, as the Russell has, on average, underperformed more large caps. But are you still happy with SMIDs? Are you looking into large caps? What do you see sector-wise?
Yeah, so what we actually did a few weeks ago is, coming into this event of volatility, we actually trimmed technology. We also trimmed our small and mid cap. We still have some core holdings there. It was a tactical trade that we plan to buy back. We think the month of May, instead of sell in May and go away, we think that the month of May is going to provide some opportunities to buy as we bottom out. And we will look to buy back the small caps and the technology large cap areas once this selling pressure has kind of gone away and we think we're near a bottom, because we do think the setup is very bullish for the summer. And we want to be in the areas that will have the biggest snapback. So again, the areas that will have the biggest snapback are ones that have the highest beta and have sold off the most. And that will be your semis, your large cap tech, as well as small and mid caps. So although we tactically took risk off, it's worked out here in the short term, but we plan to put that back on here in the month of May.
Excellent. Thanks, Eddie. Perfect answer to the question. I always appreciate the direct approach from you. So last thing, and just to give our audience a heads up, Eddie and I are sitting here before the Fed statement comes out on the 1st of May. But Eddie, just kind of broadening it, so many economists now are saying that the Fed, or expecting that the Fed, will keep rates unchanged, at least for a while. Certainly this has played a pretty pivotal role when you look at market activity, especially in bond yields, which, you look at the short end of the yield curve. I mean, and you're looking at 2 years above 5% and 6 months closer to 6. What are your thoughts here? Are you thinking that is the direction that Jay Powell and the Fed will have to go, by keeping rates unchanged, at least for the short term?
Absolutely. I mean, they continue to say they're going to be data dependent. I mean, this data that continues to come in is saying do not cut rates. I personally think cutting rates would be a very big policy mistake. And the reason why I say that is, cutting rates actually is an inflationary event, right? You're pumping more liquidity into the system, and that causes asset prices to go up. And that's the very thing they're trying to protect against. So if they do cut rates prematurely, then I think we run the risk of them having to go to a rate hiking cycle next year. And that is certainly something the market would not be ready for. So I think their message will be clear that they're going to stay data dependent. And, at some point in time, if inflation continues on the track it's on, I think you'll start to have the narrative switch to, well, maybe they have to actually hike rates. And that's our biggest headwind for our clients, that we tell them is our biggest concern is, if inflation does continue to accelerate, we're going to have to pivot because if the Fed goes to start hiking, that's going to be a major headwind, because no one's positioned for that right now.
Absolutely. And obviously, we'll all be looking pretty closely at the next couple prints on CPI, the jobs numbers. As you said, Powell has made it very clear that the Fed is data dependent these days. Eddie, thanks so much. It's always great to chat with you and get your thoughts. Good to see you, my friend.
Thank you for having me.
Thanks. Eddie Gabor again from Key Advisors. Thank you so much, Eddie. And for more information on anything we talked about, make sure you're checking out our website at ubs.com/views. And you can also follow UBS on social media. We're on all the major channels, plus Instagram. You can follow us at UBS Trending. Lots of studios content there for you to take a look at. And as always, if you have any questions about your portfolio or anything that Eddie and I spoke about today, make sure you're chatting with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.